Hey guys. So President Trump recently made a tweet and announced his plan to bring 50-year mortgages to the US. So by the end of this video, you're going to understand how does this 50-year proposed mortgage compare to the existing standard 30-year mortgage? How much do you actually save on a 50-year mortgage compared to a 30-year mortgage? The exact breakdown of difference between cost and interest, and whether I personally think a 50-year mortgage is actually a smart financial decision or not. If you're new here, my name is Alice. I have my own wealth management firm. I am a CPA, and I also work with businesses as a chief financial officer. Now, I did some research, and the average sale of a home in America, the entire country, is around $500,000. So let's say we use that average point and we have a $450,000 mortgage. The numbers break down like this. So for a 30-year mortgage, it's $2,900 a month. Total interest over lifetime is $594,000. And for a 50-year mortgage, it's $2,707 a month. Total interest is $1.174 million. The difference in the monthly payment is $193. So you do save on the monthly for the 30-year, but over the lifetime, you're paying an extra $580,000 of interest. When we actually get down to crunching the numbers, you can see that it's not really about making housing more affordable. It's just about making housing payments appear more affordable by spreading the cost over a much longer time period. And the reason for that when it comes to loans and amortization is the general rule of thumb, whether you are financing an auto loan, a house loan, financing any sort of appliances, and the longer the amortization period, the more interest you will pay over the life of a loan. When you enter into a traditional 30-year mortgage, the halfway point of the mortgage is usually when you pay off a majority of the interest. In fact, in the early years of the loan, most of the balance actually goes towards interest because your loan balance is still high. And in the later years, as the balance goes down, interest owed each month decreases and more of your payment goes towards the principal. So specifically at 6% interest rates, this means that on a 30-year loan, you'd be able to start paying more principal than interest by year 17. Whereas on a 50-year loan, you would start paying more principal than interest by year 28. Speaking of all this mortgage talk, Homegirl is actually in the process of a move. It's a decision that I've been mulling on for the better half of this year, but I've just been doing a lot of these mortgage calculations for myself. You know, what I realized is that no matter where you live these days, it's just really expensive anywhere. I actually looked into Toronto as well. I remember thinking to myself, man, I thought Toronto was supposed to be cheaper than Vancouver. It is not cheaper than Vancouver. It is like approximately the same price, if not even more. Because of the recent decrease in housing prices in Vancouver, this is not financial advice, it's just my own opinion. I felt like for myself, it was a good time and opportunity to buy. I'm so busy right now and I have so many things going on behind the scenes. I'm absolutely exhausted. And I think this move is probably going to consume a lot of my energy because the place that I'm moving to still requires work. It's not fully move-in ready yet. But anyways, we will all figure it out in the end of the day. Now, I want to zoom back in history and take a look at how we got here and when housing became so unaffordable. So the 30-year mortgage was introduced in the 1930s during the Great Depression. And in the 1960s, the average house was 2 to 3 times the average person's median salary, which means that the average person working an average job in America could afford a house in the 60s, or what we call the American dream. But this has all changed because recent data shows that the median house in 2025 now costs between 5 to 6 times, or even up to 8 times in some areas, the median household income. And the matter of the fact is that housing is no longer just a roof over our head. It really is a significant part of most people's net worth, and now even seen as a very attractive form of investment. In fact, even institutional funds and now private equity firms want to invest in real estate, including residential real estate, which means as a family in America, you are also competing with these buyers that have deep pockets. Now, there are several reasons why housing prices have gone up and why they continue to go up. The first is including zoning laws, the existence of speculative investors, developers that hold onto land for long-term purposes, all of which impact supply and demand of land, which then therefore impact housing prices. Now, if mortgages are already so expensive for home buyers, why are they extending this to 50 years? If you think about political optics, housing has now become so unaffordable, it is now a point of political contestation. In fact, I was reading somewhere that the average home buyer now is in either their 40s or their 50s. The headline that the government can now use is home ownership now made more accessible to Americans because of the housing affordability crisis. But in reality, with the way the numbers work, all they're really doing is putting people into more debt. America is a very debt-heavy society that likes to put things on credit, finance things, and really we're just giving people the option to be even in more debt than they already are. Because more than 90% of American mortgages are actually 30-year mortgages, it just goes to prove that if 50-year mortgages are indeed improved, many people will stretch to this limit. That's just the human nature of consumer finance. If you allow consumers to finance anything, typically they will spread their payments out 12 months, 24 months, the max number they can do. If you give people the option to spread out a mortgage over 40 or 50 years, a lot of them will take this option just to save that little bit of money. Car dealerships actually figured this out a long time ago. So when you go to a car dealership, they don't ask you, can you afford a $60,000 car? They ask you, can you afford a $500 a month car payment? So spreading out these housing loans and potentially car loans would be like saying that a $100,000 car is now affordable because you can finance it over 20 years. And for lenders, the math is even more simple. They make way more money. So on our $450,000 mortgage example, the 30-year mortgage profit is $580,000, and the profit on a 50-year mortgage is $1.175 million. So they're making an extra $580,000 of profit per loan. So that's why extended mortgage terms are basically among the most profitable products that lenders can offer to consumers, because they dramatically increase lifetime interest payments while appearing to help borrowers. And the main beneficiary really is the lender or the financial institution. And there's a reason why lenders love these, right? Because they help more people qualify for loans. So with our example, a family making a combined income of $14,000 a month might struggle to qualify for the $3,867 payment on a 30-year mortgage, but they might be able to qualify for a $3,610 payment on a 50-year mortgage. But again, if you can't really afford a 30-year payment to begin with, it usually means that you're already buying too much house. And if that difference between a 30 to 50 year means that you can suddenly afford the home, you're really just masking a much more expensive long-term problem. When we think about these financial decisions, I think it's also important to discuss opportunity costs as well, because that also really allows us to figure out what the true cost of these decisions are. So earlier we said that the difference in payment is approximately $200 a month. Whether it's a $400,000 mortgage or $600,000 mortgage, it ends up being around $200 a month of a difference, depending on the actual amount. Now, what if we invested $200 a month? Let's see what happens. If we invest $200 a month for 30 years at an 8% annual return, which is the historical stock market average, you would have approximately $272,000 at the end of 30 years. But remember, with the 50-year mortgage, you're still making payments for another 20 years after the 30-year mortgage is paid off. After your 30-year mortgage is finally paid off and you are mortgage free, you could then invest that entire monthly payment. So the true opportunity cost is not just $773,000 in extra interest. Real price of saving around $200 a month, or $257 in this example, is exactly why extended mortgage terms are wealth destroyers, not wealth builders. And truly, this is one of the most expensive savings that you could ever choose. And you're literally trading millions of dollars in potential wealth for the cost of a couple of dinners every single month. Let's talk about the actual generational effect of a 50-year mortgage. That is a lifelong commitment. If you are 30 years old and you take out a 50-year mortgage, you are literally going to be making payments until you're 80 years old. And that's actually conservative, because statistics show that the average first-time home buyer is around 40 years old now. So that would mean that you're buying a house and paying off your house until you are 90. But let's use the 30-year-old example. That basically means that you're going to be paying for your house for 20 years past retirement, assuming you're going to retire in your 60s. And also keep in mind that your income will be typically much lower by that point. So we have the first scenario for somebody at the age of 30 entering into a 30-year mortgage, and their house is paid off at the age of 60. Between the ages of 60 and 80, let's just say, for example, this person chooses not to retire and needs to keep working because the cost of living just keeps going up. But they now have an additional $3,800 a month, in theory, available for retirement savings and wealth building. If this person between the ages of 60 were to continue accumulating wealth, in theory, theory, they would have an additional 20 years of mortgage-free wealth accumulation. So the potential additional wealth is 2.2 million. The second scenario is we have a 50-year mortgage and this person's housing payments continue until the age of 80. Well, between the ages of 60 and 80, you're still paying that $3,600 a month in mortgage payments. And that basically means that you will not have any years of mortgage-free wealth accumulation, assuming that this person's life expectancy is around the age of 80. And so the additional wealth potential, if you think about it, is actually zero. So in a more practical sense, the person with a 30-year mortgage enters into retirement with a paid off house and the ability to invest their former mortgage payment. And the person with a 50-year mortgage enters retirement still making house payments on a fixed income. Now, what about refinancing? Now, during the COVID pandemic, there were over 14 million mortgages in the US that were refinanced, and these things do happen. So if you ever choose to refinance your mortgage into longer terms throughout your life, you could be literally paying your mortgage into your 70s or your 80s or even your 90s, making retirement significantly more stressful because 30 to 40% of people's Social Security and pension income tends to go to housing payments. Ultimately, it doesn't just affect you, it would affect your children's inheritance, your family's ability to build generational wealth. And instead of leaving your kids a paid off house, you might be actually leaving them with debt and mortgage payments. Now, one option that I personally really like is a 20-year or a 15-year mortgage. I really think that if you can afford higher payments, a 15-year mortgage, actually, if you look at the math, is going to save you enormous amounts compared to any longer term option. People typically gauge what they can afford by backtracking and just looking directly at the 30-year mortgage, but you actually end up saving so much interest if you can just go with the 15-year option. And then the last alternative is to make additional principal payments. So if you take a 30-year mortgage, but you're paying an extra $400 a month towards principal, depending on the agreement that you have with the lender and whether they allow this without any penalties, you can cut your mortgage down to about 20 years and save over $200,000 in interest. So this is a good option for people who have the extra cash flow and can exercise the discipline to do this. So the data shows that people who buy houses with 30-year, maybe even 20 or 25 years, maybe even 50 years if you can, or they wait to improve their financial situation before they buy, assuming that they have the same financial habits over their lifetime, will end up wealthier than the person who stretches to buy this gigantic house with a 50-year mortgage and is stuck paying it till they're like in their 90s. If you guys like this video today, let me know what you guys think about this new 50-year mortgage proposal. Is this something that you're considering? Make sure to leave me a comment down below and I promise I will get to it as soon as possible. And if you enjoyed this video today, you're gonna love my other video on how are people affording these car payments, where I talk about how much you should be spending on a vehicle based on your current income level. That's all for now, guys. I'll see you guys in the next one. Until next time.